Drowning in dense research papers? Deep Dive is where two AIs break down academic and market research, so you don't have to. From quant finance to AI policy to economic models, we translate it, explain it, and deliver what matters. Like, share, subscribe, knowledge should be accessible, not locked in PDFs. Fresh AI insights delivered regularly.
Okay, so you've probably seen that classic image from finance textbooks, right? That smooth curve, the efficient frontier.
Yeah, the one showing the best possible return for a given risk level. It's fundamental.
It is. But here's the thing, that perfect picture, it assumes something totally unrealistic in the real world.
Zero transaction costs.
Exactly. Zero costs. I mean, imagine that. It's fine for a whiteboard, maybe a tiny simulation.
Right. But if you're a big player, think huge pension funds, asset managers with billions.
Trillions even.
Trillions, yeah. Trading costs aren't small change. They're huge. You actually move the market when you trade big. That's market impact cost.
Uh-huh. And that brings us right to the core issue this new research paper tackles. It asks, okay, machine learning is great at predicting theoretical returns, right?
It's gotten really good, yeah.
But when you add in the cost of actually trading, do those smart ML predictions just point to things too expensive to trade? Or can ML find patterns that lead to strategies you can actually implement? Strategies that make money for a big investor after all those costs?
That's the million-dollar question, or maybe billion-dollar question here. And this paper really dives deep.
And that's exactly what we're doing today. We're unpacking Machine Learning and the Implementable Efficient Frontier by Jensen, Kelly, Malamud, and Peterson.
And crucially, they don't just point out the problem. They offer a solution grounded in, solid economic theory.
So our mission for this deep dive,
It's to figure out their key findings, understand how ML can build investment strategies that are actually workable, profitable, after you pay the piper, after the trading costs. They call it a tractable solution, baking economic theory right into the ML process.
Okay. Before we jump into their solution, let's really nail down the problem. Why does the standard way of using ML in finance just fall apart when costs get involved?
Well, the typical way, it's like a two-step dance. First, you use your ML model to predict returns. Often it's, say, 1 month ahead. The paper calls it E-tree plus 1.
Right, the expected return for stock in next period.
Exactly. Then, step 2, you take those predictions and build your portfolio. Maybe using classic Markowitz optimization, or maybe something simpler, just buying the top predictions, selling the bottom ones.
Predict, then trade. Seems logical.
On paper, yes. But the big failure, that two-step process totally ignores trading costs and, importantly, turnover, how much you have to buy and sell. So what happens is these strategies end up chasing fleeting small-scale characteristics. Think short-term reversal, buying losers, selling winners really fast.
The stuff that flips constantly.
Yeah, exactly. These signals might look predictive, especially maybe in smaller stocks, but trading on them means constant churning, high turnover.
And for a large investor, that churn means massive costs.
Precisely. The paper looks at standard benchmarks like Markowitz ML, that's Markowitz fed with ML predictions, and factor ML. And they find, after accounting for trading costs, these things have highly negative net returns.
Ouch.
Negative. And worse, negative realized utility. Basically, the investor is worse off after considering returns, risk, and costs. They just trade way too much. They're infeasible for someone managing serious money.
So that beautiful textbook, Efficient Frontier, it's basically a mirage for big investors.
It really is a theoretical ideal, not something you can actually reach with big money using standard methods. Now, they do look at a slightly better approach called static ML.
Okay, what's that?
It's still kind of two-stage, but it does try to factor in costs in the second stage when building the portfolio after the ML has made its cost-blind predictions, and it manages a positive net Sharpe ratio.
Okay, positive Sharpe is better than negative utility for sure.
Definitely an improvement, but in its basic version, even static ML gives you lower utility than just sticking your money in T-bills. The paper argues it still relies too much on those short-term, 1-month-ahead predictions. It doesn't fully grasp how alpha, the predictive edge, decays over time. It adds costs later, but the prediction itself wasn't cost-aware.
Right. And this is where the paper gets really clever, the big innovation. Instead of predicting returns first and then worrying about costs,
They build the trading costs directly into the machine learning model's goal, its objective function.
whoa, okay, so the ML isn't just trying to find high gross returns anymore.
Exactly. It's trained to maximize the investor's utility. That means return after risk and after trading costs. They feed the ML explicit knowledge of implementability. It learns to find usable predictive patterns, signals you can actually profit from, while automatically learning to ignore the flashy signals that are just too expensive to trade for a big player.
So it learns profitable trades, not just good-looking predictions. That makes sense.
It's a fundamental shift. Their main method is called Portfolio ML. And instead of predicting returns, it learns directly about portfolio weights.
Okay, how does that work?
It finds a function based on current signals. They call it the AIM portfolio, ACE. This is the target portfolio you want to hold, considering signals and costs. But crucially, it doesn't just say jump there instantly. It knows where you are now, and it knows the cost of moving towards that target.
Got it. So the ML's output isn't just stock X will go up. It's based on everything, including costs.
Yeah.
Your optimal holding in stock X right now should be Y, considering where you are.
You got it. It learns the optimal action, the portfolio, directly, not just the prediction. They also talk about another method, multi-period ML.
Okay.
This one tries to be smarter by predicting returns over multiple future periods, 1 month, 2 months, 3 months out, and so on. Then it uses all those predictions together to figure out the AIM portfolio. More forward-looking than just the next month.
Right, trying to capture more dynamics. Okay, so we have the problem, standard ML fails net of costs, and the proposed fix, portfolio ML building costs right in. Did it actually work? What did the results show?
Oh yeah, the results are pretty striking. They simulated a large investor, $10 million AUM, standard risk aversion. Table 2 in the paper lays it out.
Let's hone in on that. What did it show for the standard methods?
For that $10 million investor, Markowitz-ML, Factor ML, even simple stuff like 1N, all negative realized utility after costs. They effectively lost the investor money or made them worse off than holding cash.
Wow. Just hammers home how misleading theoretical performance can be.
Totally. But then you look at the cost-aware methods, static ML, multi-period ML, and portfolio ML, they all delivered positive net Sharpe ratios and positive realized utility.
And the winner was?
Portfolio ML. It delivered an out-of-sample net Sharpe ratio of 1.33.
1.33 for a $10 billion portfolio net of costs.
Yeah.
That's actually really impressive. That's real usable alpha.
It is. It's a big deal. And Portfolio ML consistently gave the highest realized utility of all the methods they tested. It's also worth noting the other cost-aware methods, static ML and multi-period ML, they only got into positive utility territory after adding an additional layer of portfolio tuning, like extra knobs tweaked after the ML part to manage things better.
Ah, so they needed extra help.
Right. But Portfolio ML, because it learned about weights and costs from the start, got that top performance without the extra tuning. It just shows the power of building implementability in from the ground up.
Did they quantify how much better it was?
They did. Portfolio ML beat static ML by about 60% in Sharpe ratio terms and, get this, 290% in utility terms, out of sample, net of cost.
290% better utility. That's enormous for investor well-being.
Huge difference. And figure 2 shows it wasn't just a fluke. The performance was, relatively consistent over time. Obviously, it dipped in big crises, 2000, 2008, 2020, like most things.
Yep. Okay, so it works significantly better. The big question then is how? What's the mechanism? How does Portfolio ML pull this off?
The main reason is actually pretty simple. It keeps trading costs lower.
Just by trading less often.
That's a huge part of it. Table 2, again, Portfolio ML, had a monthly turnover of 25%. Compare that to 58% for multi-period ML and a whopping 68% for static ML.
Wow, 25% versus nearly 70%.
Yeah.
That's a massive difference in churn.
Massive. Less trading means way lower transaction costs, especially when you're big.
Does it also trade differently in, harder to trade stocks?
Absolutely. That's the other key piece. It focuses on more liquid stocks. Figure 3 shows the weights across liquidity groups, standard Markowitz ML. It's agnostic to liquidity. Sure. It might tell you to put a huge chunk in some illiquid stock if the theoretical return looks good, ignoring that trying to buy that much would kill you on impact costs.
Right, the cost of actually executing the trade.
Exactly. Portfolio ML, in contrast, holds much less in those illiquid names. Figure 4 has a neat example, comparing weights in, say, liquid J&J versus less liquid Xerox. Markowitz ML is jumping all over the place in Xerox, chasing predictions. Portfolio ML holds way less Xerox and adjusts that position much more slowly, smoothly. It knows trading Xerox is expensive.
So it's smarter about what it trades, how much, and how fast it adjusts, especially in those costly illiquid stocks.
Precisely. The paper's theory section, Proposition 3, explains this. The optimal portfolio doesn't just teleport to the theoretical aim portfolio, it moves towards it at a trading speed that depends on costs and future return predictions. And that aim portfolio itself is smarter, more forward-looking. It considers returns over multiple periods and knows the difference between signals that stick around and signals that fade fast, the alpha decay. It targets positions that are profitable and actually possible to trade into.
Okay, that makes perfect sense. And that leads right into which signals, which characteristics actually matter for these implementable strategies. They looked at economic feature importance, right? Like how much does performance drop if you take away a certain group of features?
Yeah, Figure 5 shows this, and the comparison is fascinating. For the standard frictionless Markowitz ML, the important features are things like short-term reversal, momentum, value, the usual suspects known to predict gross returns, often in academic studies focusing on small stocks. Markowitz ML loves those transient features.
The stuff that looks good on paper, but for the cost-aware portfolio ML.
The picture changes completely. Quality, value, and momentum themes are still important, but short-term reversal, its importance plummets. It drops significantly.
Because it's too expensive to trade for a big player.
Exactly. The signals that drive implementable profit after costs are different. Portfolio ML naturally gravitates towards persistent features of economic importance. Quality features, for example, are really sticky. They have a median autocorrelation of 0.93.
Meaning they don't change much month to month.
Right. Highly persistent. That directly leads to lower turnover, lower costs. Even momentum, while parts of it are fast, Portfolio ML seems to pick up on the more persistent aspects or use it carefully to manage costs.
And Figure 6 really drives this home visually, doesn't it?
It does. It shows what happens to the implementable efficient frontier if you scramble different feature groups. Mess up quality or value, the frontier for Portfolio ML tanks. Those are crucial. But scramble short-term reversal. Barely any changes.
Because it wasn't really using it much anyway.
Precisely. Because it learned it was too costly. But for the frictionless Markowitz ML scrambling short-term reversal has a greatly impact on its theoretical performance. It's clear proof. Accounting for costs fundamentally changes what signals matter.
So insightful. The paper also checks robustness, right?
Yeah.
Like how does investor size affect things? Or other costs, like short selling fees.
Yep. Figure 1b is stark. It shows the implementable efficient frontier gets strictly worse as your assets under management, AUM, go up.
The cost of being big.
It really is. More AUM means higher market impact. You can trade less to reduce impact, but then you have opportunity cost. You can't fully capture the signal because moving the necessary size is too expensive. So bigger investors face a tougher trade-off. They quote an example. At 11% vol, a $10 buy investor gets 14.6% net return, but a $1 Bauer investor gets 16.3%. It shows the substantial cost of being a large investor.
Makes sense. What about short selling costs? Another real-world friction.
They looked at that using data from 2003 onwards. The estimated annual costs were pretty low for Portfolio ML, like Miller 0.5%, a bit higher for the others, around 1.2%. Figure 7 shows these costs cause meaningful but modest drops in utility.
Only modest. Why not a bigger hit?
Primarily because the actual fees to borrow most large-cap stocks, the universe they study, are quite low. Plus, they point out, if you factor in the money you make lending out your long position securities lending revenue, the net securities lending costs are even smaller. The bottom line performance ends up almost identical to the performance before considering shorting cost. So the strategies stay profitable.
Good to know. And did the main finding Portfolio ML rules hold up if you looked beyond just large cap stocks, like in smaller stocks?
Mostly, yes. Figure 8 shows results across different size groups. The general ranking holds. Portfolio ML best, then multi-period ML, then static ML. The one exception was in the very smallest stocks. There, multi-period ML and static ML actually edged out Portfolio ML slightly.
Huh. That seems a bit odd. You'd think cost awareness would be most valuable in the illiquid small stocks.
It is a bit counterintuitive. The paper suggests potential reasons, maybe data issues for the tiniest stocks over the long history or changes in what kinds of stocks are in that bucket. But even there, the dynamic methods still gave positive utility. And importantly, they ran a separate, clean simulation in the appendix, and that showed dynamic methods like Portfolio ML do provide a large benefit for illiquid stocks compared to static ML.
Okay, so simulation confirms the intuition. Still, any real-world caveats we should keep in mind?
Oh, absolutely. And the authors are good about mentioning them. This is simulated performance. Real investors might face manager fees or maybe didn't have access to this level of ML tech back in, say, the early 2000s, part of the sample.
Fair enough. Simulation isn't reality.
True. But, as they argue, the statistically significant outperformance of portfolio ML relative to other methods is an encouraging apples-to-apples test. Within their framework, comparing like for like, building costs directly into the ML objective clearly wins.
Okay, let's wrap this up. This deep dive into machine learning and the implementable efficient frontier. It really answers that initial question definitively, doesn't it?
It absolutely does. It shows standard ML ignoring costs, fundamentally broken for large investors. Looks great theoretically, fails miserably in practice, net of costs. But this paper shows how you fix it. Build those costs into the ML objective. That portfolio ML approach creates a much, much better strategy. It pushes out the implementable efficient frontier, delivers real positive utility, and beats the other methods hands down by just being smarter about costs and turnover from the very start.
And the key takeaway for you, listening to this, is that the textbook efficient frontier isn't the goal. If you're managing real money, especially significant amounts, you have to focus on the implementable frontier performance after trading costs. And what drives success there is different. It forces you towards more persistent signals, smarter trading, especially in stocks that are expensive to move. The friction of the market changes everything.
It shifts the game from just predicting returns to actually learning how to trade profitably given the constraints.
Which leaves us with a really interesting thought from the paper's conclusion to chew on. They observed that their findings that cost-aware ML makes different things matter for different size investors. Maybe small guys chase fast signals, big guys need persistent ones. Well, it kind of resembles how high-frequency traders remain relatively small, while successful asset managers often grow large.
Yeah, it makes you wonder, right? Does the whole structure of trading costs and these implementability issues fundamentally carve up the market? Do different types of investors specialize in extracting profits from different types of signals purely based on what's feasible for their size and cost structure? HFTs grabbing fleeting pennies, large managers grinding out alpha from slower signals.
Are they almost playing different games on the same field, dictated by scale and cost? It certainly makes you think differently about how all these players interact and shape the market. A really powerful insight to end on.
Still here? Then you're not just scrolling. You're searching for substance. This isn't just another quant podcast. It's AI translating complexity into clarity. So smart ideas reach smart minds. Like, share, subscribe, join the thinkers, skip the noise. Let's make research accessible. Together. Liked how that paper got decoded? We've spent 20+ years turning machine learning and AI into real-world tools, not just slide decks. Whether you want to implement a model, validate research, or build something from scratch, we can help. Explore our showcases to see it in action. Visit our site or contact us directly. Let's turn complex ideas into working intelligence together.